Good evening, ladies and gentlemen. Welcome to Business Today Television. In the ongoing series that we are holding on how to navigate the markets at a record high, today we are joined by Mr. Mihir Vora. He's the Senior Director and Chief Investment Officer at Max Life Insurance Company, manages about 1,30,000 crore rupees in his overall portfolio, of which 35,000 crore rupees is invested in equity shares and is also very long term in nature, he being looking after money for the insurance space. As also of this 35,000 crore rupees, 4,000 crore rupees has come in over the last 12 months. Welcome Mihir bhai, it is such a pleasure to see you, and welcome to an environment where whatever you are buying is going up. The mood, the instance and all that is around us points to a Goldilocks rally in equity markets. How are you watching this space?
Good afternoon, Shail. Always a pleasure to join you. I can see that market is in the pink of health and you're wearing a pink shirt too.
Yes.
and
Although I'm sure the color will suit you better.
and you said whatever I'm buying is going up. The problem is whatever we have not bought is also going up. So that's also the
Absolutely.
problem.
So, Mihir bhai, let's start with the basics. Firstly, what is driving this rally? And obviously, the smile on your face tells me that your own portfolio is in the pink of health. I'm sure your treasury fund manager, your equity fund manager is having a gala time looking at Bloomberg screens and notching up gains one day after the other. What do you think are the underlying 2 or 3 reasons for this rally that we are seeing?
Sure. So very clearly, one is India's absolute position. Second is India's position relative to the rest of the world. And I think third is the fact that we are finally getting out of the worst of the tightening phase as far as the global central bank action is concerned. So if I were to just elaborate on each of the points, India's inherent GDP growth rate is anyway somewhere between 5.5 to 7%. So even if it's a 6% over the next couple of years, it still makes India one of the fastest growing large economies in the world. So the second point is that related to everybody else, India shines out in terms of growth, even though, of course, we are very ambitious
Show
and we
more
always
data.
want we want the Indian economy to grow at 7 to 8%. But even 6% is a very good number in the global scheme of things, relatively speaking. So that's India's absolute and relative position. The second big thing that has happened in terms of India's relative position is that China is increasingly becoming a cross, a question mark and a cross for a lot of global investors. And we have a lot of global pool of capital which needs to be deployed. So the one of the very few markets which is fast growing and can absorb relatively larger pools of money is India. So in the last 3 or 4 months, we have begun to see that kind of shift also happening, which is money which would have otherwise probably gone to countries like China coming into India. So I think it's a confluence of these absolute and relative positions. That's one. And the second is, I think, this whole central bank action, which was basically premised on inflation being out of control, seems to be at its peak. So the peak of hawkishness, the peak of the tightening, the peak of liquidity concerns are probably past us, and we now we now are of the belief that even if the absolute prices of commodities don't go down significantly, but inflation is calculated on year-on-year basis. So even if prices remain flat, then we should see inflation anyway naturally coming down, which is what probably the central banks are looking at. Growth has slowed down. US will slow down, probably not go for a recession, but it will slow down to nearly 0% growth rate. Same for Europe, sluggish growth. China is just not picking up. For the last 4 months, we've been hoping that China, after coming out of COVID and undoing the COVID lockdowns, would come back very sharply, but that's not happening. So I think that puts a upward cap on commodity prices, oil prices, and inflation. And to that extent, it's good that we are probably past the peak hawkishness for central banks, which is good for flows.
So, Mihir bhai, before we dissect your own portfolio, I want to ask one very basic question, which should put a lot of fears that are in the minds of new investors to rest. Everything is going good for India. You've mentioned uh, great GDP growth, island of relative safety. Our foreign funds are pouring in money, about a lakh of crores over the last 4.5 months. What do you think can derail this?
I think what can derail is the biggest concern is geopolitics. If you see something really untoward happening on the Russia-Ukraine front or US-China, China-Taiwan, so lots of moving part on the geopolitical side, which can impact not only flows but also oil prices, disruption in oil prices, and going back to the inflation scenario. So that is one significant risk factor that one needs to keep in mind. Second is, if inflation for some reason does not come under control as expected, then you might see a prolonged phase of tightening, which is a low probability scenario as of now, but that's another risk that I'm looking at. India specific, I think the key risk we need to watch out is if the global economy, continues to slow down significantly, which it is. What happens to exports, and does that impact domestic GDP growth, especially in sectors like IT, etc. So these are some of the risk factors that we would look at. So as of now, we are kind of in a Goldilocks phase where it's not too hot, it's not too cold, and India seems to be in a good spot.
Okay. And Mihir bhai, you are in one of those amazing spots where you really don't have to, on a daily basis, look at how your peers are outperforming or underperforming and how the broader markets are spaced, because you manage money for an insurance major, and it's for the real long term. Now, let's analyze your portfolio. How do you think you are positioned? Is it a top heavy blue chip kind of a portfolio where you are holding faith in all those 30, 40, 50-year-old names that we've seen so long outperform the Nifty and the Sensex? And how are you putting in fresh money?
Sure. So, we have a diverse range of products, and to that extent, we have a diverse range of funds also. So, we have funds ranging from very large cap funds to mid and small cap funds, and we also have diversified what typically mutual funds call the flexi cap category. So, we have products across the spectrums, and because of that, we have investments across the spectrum of market cap also. So, we are really, in terms of preferences, sector agnostic. We will go into whatever sector we really like, go overweight, and vice versa. What we don't like, we can go significantly underweight. And even in terms of market cap, we have flexibility. So I think in our diversified funds, we are kind of now, I would say, more biased towards the large caps, since the run up in small and mid caps has been quite sharp. So to that extent, we are kind of getting a little cautious on that end of the spectrum. Though we are fully invested on an overall basis, the equity exposure is still at full levels. But within that, probably we are shifting a little bit away from the mid and small cap because of the valuation issues. Second is, as a theme, I would say we are focusing more on the domestic recovery, on the domestic segments, and domestic thrust that the government is giving in many areas like infrastructure, defense, manufacturing. So I think we are quite significantly over on the domestic theme, not so much on the exporters or the outward looking sectors.
Mihir bhai, one really interesting data that I came across over the last 2 or 3 days is that a lot of our small cap peers, friends who manage mid cap portfolios, are actually now refusing money, mainly on account of probably the valuations that you mentioned. So that's probably one sign that the market has overheated in one part of that segment. The other thing I wanted to understand from you is the capital goods space. All the old favorites, the AI engineerings of the world, Siemens, ABB, mid cap space like Elecon Engineering. I know you will not comment individually on stocks, but as a group, where do you see capital goods stocks headed? Are we in for a multi-year run here?
I certainly hope so. And, couple of reasons. One is the hope part, and second is the reality part. Uh, I think basically India, even now, is really driven by consumption. And consumption can only take us so far as growth is concerned. So consumption growth can take us to 4.5, 5.5% GDP growth, which is good, not too bad. But it also creates a trade deficit and a current account deficit at some point in time. If we need to go to that trajectory of 7 to 9% GDP growth rate, which is what China did for many, many years, and that's why it's now 5 times our size in terms of GDP. When in the early 80s and 90s, we were the same size. The economies now they are 4 to 5 times larger. That's because they compounded their GDP growth rate at 9% for like almost 20 years. So if we want to do anywhere between 7 to 8% or 9% GDP growth, it cannot happen without investments, both on the private sector side as well as on the government sector side, especially on the infra side. So I think the government also fully realizes that, and more incentives are being given for local manufacturing to facilitate manufacturing. We are doing some lots of things on the policy front, but also creating a lot of infrastructure, whether it's roads, ports, airports. So that's on the infra part. And for the private sector, we are really encouraging, segments where local manufacturing becomes a reality. For example, the PLI schemes in so many sectors: electronics, textiles, chemicals, auto. Uh, all those segments are going to see a lot of investments already on the ground. Second is defense, which is one of our largest import items. A lot of emphasis on Atmanirbharta and local manufacturing in defense. So to that extent, I think this whole PLI scheme plus local manufacturing thrust for defense, etc., should create a lot of action and a lot of investments on the private sector side also. So I think the government continues to spend on roads, railways, etc., incentivizing the private sector on PLI schemes. And of course, real estate is a function of everything. As long as there is prosperity and jobs being created and market cap being created, real estate should continue to do well, especially the rural real estate side. So I think the cap goods, infra, construction, I would treat this as one bucket. Is a segment which will have to do well if we are to grow at 8 to 9%, and that's where the conflict. That's where the confluence, I would say, of hope and reality is. A lot of action happening, a lot more need to be done.
Yeah. The other untouchable part of the market, at least 3-4 years ago, was the PSU basket. You've beautifully touched upon defense, which our data shows has been the best performing sectoral push since December 31st. Year to date performance up about 50%. Mihir, what has changed in the PSU banking landscape? Some of the stocks that you and I track over the last 3 months, 4 months, 5 months have actually doubled. And, the margin of safety, at least on the price side, is still huge. Does it gladden your heart when you see quarterly earnings of PSU banks, NPAs going down, gross NPAs coming still slowly in, as also the fact that now a lot of write backs might just be coming in? How are you analyzing the PSU banking basket?
So there are pockets of value, and I think one of the reasons why PSU banks did so well is that almost for 1.5 years, private sector banks did outperform a lot, and there was a lot of valuation gap differential which was created between the PSU and the private sector banks. So I think that was a catch-up trade, waiting to happen. So that's one big reason. Second is in the last 3 to 4 years, a lot of PSU banks have raised capital. They've also cleaned up the balance sheet by making lots of provisions. So there was a really terrible time between 2018 to 2021 where PSU banks were in the cleanup process. What has happened is that we haven't really seen a lot of corporate investments in the last 4 5 years. So the chunky lending by PSU banks has not happened. Most of the incremental growth has come from the MSME sector, from the retail segments, which are traditionally high margin segments. And because we don't have now incremental chunky exposure, that big NPA issues are unlikely to happen, at least in the shorter term. We may see a NPA issue in the later part of 2024-25 when if there is a problem on the retail or MSME side. But otherwise, now the exposure of the banking system is very granular, not chunky as in the past. So that to that extent, there is a de-risking that has happened in the segment. And with the cleaned up balance sheets and credit growth picking up, it makes a good combination, especially at current valuations.
Absolutely. So two things continue to remain positive for the overall PSU banking sector. A very strong CASA that's coming in, lower NPAs, and of course, as the interest rate cycle softens, their bond portfolios will now outperform, so treasury income will rise over the coming 1 year. So, Mihir bhai, till about 2 days ago, the IT sector was one of the pain points that we were experiencing in the market over the last at least 3 months, and suddenly, just 2 days ago, despite tepid earnings from TCS and HCL Technologies, we've seen a very, very sharp rally on the index level and on frontline counters. Are the bad times, especially for IT stocks, over? How do you compare the sector vis-a-vis the stock performance?
So I think that was a bit of a mean reversion that was very that was likely to happen, or rather waiting to happen, I would say. After having performed stellarly well in 2021-22, we saw sorry 20 and 21. We saw 22 as a correction year for IT, significant correction. So almost for 15 months, IT sector had outperformed, not without reason. A, valuations had become too high, and the sector itself was slowing down along with the rest of the US economy. So we did see a downgrading of the sector for almost 15 months. And the other domestic segments did very well. For example, banking, capital goods, as we discussed, even consumer durables like automobiles, etc. They did very well in 15 months. So the valuation gap probably had opened up, and there's a mean reversion trade. But if I were to take a structural, say, 3-year call, I would still stick to the domestic segments because there are headwinds in the US, and I don't think we have seen the kind of growth. And I think the kind of growth that we saw in the US IT spending in 2020-21 is unlikely to get repeated very soon. So to that extent, I would still prefer the domestic segments.
Okay, so Mihir, chart for us a course for the next, say, 1 year or so. Inflows are actually getting thicker and fatter because the feeling of missing out is very high on the Lal Street. You'll be on a monthly basis deluged with cash. How do you intend to deploy this money which is coming in over the next 12 months or so? Sectors that you like, allocations that you would prefer, and where is the market headed 1 year from now?
Sure. So clearly, if the Indian economy grows, then the biggest beneficiary and the biggest driver has to be the financial sector, which is also a very large portion of the index. So a lot of the incremental money will go into financials. Within financials, we are still biased towards banking. But in the last 4-5 months, the differential between the private sector banks and the NBFC segment had opened up quite a lot. The valuation gap had become too much. So we have actually added some NBFCs to the portfolio, mid cap as well as large NBFCs to the portfolio, because as we discussed, the funding tightening is past us, and NBFCs tend to do better when there's an interest rate easing cycle. Valuations had become very attractive versus the banks because NBFCs had outperformed. So within financials, we are probably biased a bit towards NBFCs compared to before. And of course, private sector banks remain the favorites with a little bit of exposure to PSU banks because they are there in the index. So financials is one big segment. And the other domestic theme that we are playing is the the whole capex cycle, including real estate. So we have some exposure to real estate, and we have exposure to the capex themes like construction and defense, and also to some extent some of the local manufacturing themes like electronics manufacturing and chemicals. We are also betting on the domestic consumption to do better now. I think the automobile sector had underperformed quite a lot for almost 4 or 5 years, and that is also catching up, especially the two-wheeler segment. So that is also something that we are watching with keen interest. With the monsoons, almost normal now, it does look like the rural economy should also pick up, and which means that the car demand, the two-wheeler demand, which was tepid, should now pick up significantly in the second half.
Okay. Mihir, another point that I wanted to get clarified from you, the new age companies, the ones that, announced IPOs in, say, August of 2021 till December of 2021, very, very high prices, the likes of Paytm, Policy Bazaar, Nykaa, Zomato. Somehow they've, after being brought down from stratospheric levels to what we see now, they have some kind of a liking in a certain category of fund managers. Since you invest for the very, very long term in the insurance sector, do these stocks or does this sector form a recent part of your portfolio?
Yes, so we mostly did not participate in the IPOs because at that time we found it difficult to understand the valuations. Uh, so of course those valuations did not hold and we did see sharp corrections. I think the correction was also accelerated by the fact that it coincided with the tightening cycle of interest rates. And these stocks are inherent, very fast growth stocks. And growth stocks don't tend to do well in a tightening cycle. So I think high valuations combined with tightening cycle in most of the all of 2022 and early part of 23, I think did ensure that the valuations came down to reasonable levels. So now, as we discussed, we are now looking at an easing cycle. So probably growth will come back into favor, and with valuations down 60 to 80% in a lot of the stocks, we do believe that there is some franchise value. These are businesses which have scaled up to a level, especially the listed space has scaled up to a level where now incrementally, I don't think any VC or PE funded guy can match up to their sizes. So
Yeah.
the customer base is there, the logistics and infrastructure has been created, the network effect is there. And with good valuations, I think it can be a good idea to now start taking exposure to these new companies because these models cannot be replicated very easily now.
Okay, so it's a full circle, ladies and gentlemen. Mihir spoke about almost every sector under the sun that's booming on the Indian Dalal Street at the moment. Mihir, a couple of final questions. Everybody that you meet on the road, in a party or at a dinner at your home, is having this intense feeling of missing out this super wonderful rally that we are seeing unfolding on Dalal Street. Given the corrections that often take place in these kind of setups, and some of them are sudden, how do you advise investors to navigate the next 3 to 5 years?
So 3 to 5 years is a very easy call. Stay invested and stick to your investment plan. Frankly, the 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 difficulty is when you ask me for 1 or 2 months or 6 months. I think with a country like India, as long as you invest reasonably over a reasonable period of time, as we keep saying, it's kind of gisa, as we say gisa pita phase, but very relevant. That timing the market is less relevant. It is time spent in the market that is more relevant. So I think staying invested for a long period of time is the only way you can really generate wealth, unless you have some superior insights like you.
Okay, and the final question, Mihir, where will this money go into? Would you advise maybe some kind of a exposure to the bond market, given that interest rates are likely to now soften from these levels? Or would you be a pure equity animal over the next, say, 24 to 36 months?
So it's really a function of, I mean, asset allocation is a function of your age, risk profile, demographic profile, social responsibilities, etc. So the younger you are, the more you would go into equities, and as you grow older, you would probably shift more towards fixed income. So it's a function of that. Plus, what are your short-term liabilities? If you have some expenses coming up in the shorter term, that money you probably will not put in equities. You'll keep it aside in a fixed income. So those kind of decisions one has to take based on one's requirements and profile. But as a thumb rule, the longer the horizon, the better it is for equities.
Wonderful. Thank you, Mihir Vora, for joining us on this special show on Business Today Television. We wish you the very best in terms of your funds that you manage, and of course, the wonderful inflows that are coming on a monthly basis into Max Insurance Life. This is going to be a fantastic rally, and we hope that you will join us more frequently to share not only your insights into markets, but on how to navigate this record move that we are seeing on a lot of indices in India. Thank you for watching us, ladies and gentlemen. Do stick around with Business Today Television, and we'll tell you how exactly to invest in this kind of a market and where to make supernormal money. Thank you for your time.